America's entire economy is built on the ability to borrow money. When borrowing stops, the entire economy comes crashing down. If you want a quick reminder of what happens when consumers are unable to attain a mortgage, check back to 2009 in Las Vegas to see how quickly prices cratered when mortgage lending dried up. Cash is king in an environment when lending constricts, and prices will race to the bottom to match the point at which a cash buyer will enter the market. After the debacle of the Great Financial Crisis, mortgage lenders have improved their lending practices in order to ensure that more qualified buyers are purchasing homes. In this video, I'm going to explain why I believe there's still a huge hole that remains in the system, why algorithms can only get us so far, and why a certain segment of the population was unfairly left out of the lending game and how it's impacting that group today. Let's start with the 5 C's of credit. Lenders adhere to a simple system for determining how qualified a borrower is when they're asking for a loan. The 5 C's of credit are character, your credit score, and how likely you are going to pay back the loan given your history of borrowing. Capacity, your ability to repay the loan given your income and expenses. Capital, the ability of the borrower to service the debt and cover any down payment. Condition, the amount of the loan, interest rates, and where the money will be going. Collateral, does the borrower have the necessary reserves to handle debt service in the event something goes wrong? Flaw number 1 is that lending can be too algorithm reliant. I provide all of the necessary data to a lender, they plug my info into a form, and the form returns with some data of its own. How much I can borrow, what my interest rates will be, and what type of financing I qualify for will be what the mortgage broker explains to me. And if I were on an HGTV show, I would explain that I was in the market for a $1.2 million house on an office assistant salary. I love software engineering, so I'm a huge fan of algorithms and frameworks, but there are always flaws when a human is writing the code. How does an algorithm show integrity? How does the algorithm know that you will do whatever it takes to pay down the loan to make sure your family still has a roof over their head? And how does an algorithm know that you made only one bad decision 5 years ago, and that's keeping you from being approved for a loan today? One of the most popular mortgage loan products is the FHA program, which allows home buyers to borrow 96.5% of the home's value as a mortgage. The remaining 3.5% would come from the home buyer in the form of a down payment and serves as a great opportunity for first-time homebuyers to purchase a home. But this also means that these homebuyers are underwater on their house from day one due to the costs associated with selling a home in the event that they reach foreclosure within the first couple of years after purchase. So why can someone with only 3.5% down as the down payment attain a mortgage while their neighbor is unable to? Well, their neighbor's career of tough physical labor and unstable income doesn't meet the criteria of the lender's algorithm, even though he's paid back every single loan he's been given in life and makes twice as much money on average as the FHA borrower down the street. This is just an example, but highlights what I find to be perplexing with the mortgage lending industry as a whole. Anyone can game the algorithm if they really wanted to. Given the amount of credit repair businesses that have been created in the past couple of years, any number of them can share with you the secrets to getting inquiries removed, delinquencies removed, and the strategy of using authorized user access to someone with great credit history to give your score a bump. You can have people with the integrity of a seasoned criminal with great credit. You can also have people who have made every payment to their creditors on time, but because they decided to not join the system and the banking system, they'll never attain a loan. Character isn't quantifiable in an algorithm. They say it's a component, but let's be real, it's not. How do you evaluate someone's character? You put them under tests and you analyze how they respond. You analyze their actions and behaviors, not their words. Unfortunately, an algorithm can't understand this. I want you to envision something right now. You have $500,000 in your pocket and someone is asking to borrow it from you at a specified interest rate. What 2 things are you going to look at when considering the loan? If you were me, I'd analyze their history of income versus expenses and their character. Is this person going to make payments on time and be able to pay me back in full? That's the essence of what every lender looks at. There are some people I know that I wouldn't lend $20 to, even though they meet all of the criteria to be considered a great borrower. On the flip side, there's people I know who have terrible credit scores, but they're the first people I'd call if I ever got in trouble. The difference is character. The pandemic will provide many lessons to us, one of which is how fragile W-2 jobs are and can be. I'm someone who lost my job even though I was severely underpaid and underemployed given my skill sets, and the company went public and raised hundreds of millions of dollars while I was furloughed. A W-2 job is masked as stability because for the past few decades, it was stability. Think about this, before the great financial crisis, there weren't careers in renting out your home while you were away, or driving strangers in the back of your car, or making YouTube videos. The gig economy, social media influencers, the prevalence of remote work, freelancing, there have been massive changes to what we consider the economy and how we treat work and employment over the past decade. Baby boomers still think that it's smart to work for one company for the entirety of your work career and focus on being that diligent little worker because the company will reward your commitment. Long gone are pensions, steady pay increases, and the promise of an employer doing right by their tenured employees. How does this relate to mortgage lending? The algorithm rewards people who have a W-2 and punishes those who do not, even though I'd argue that those who could go earn their own money are way more reliable financially than someone who is underemployed living paycheck to paycheck. Companies will cut W-2 employees whenever they want. They're just as vulnerable to income loss as contractors, seasonal workers, and gig economy workers are. It's just masked as stable based on antiquated thinking. The point I'm trying to make is that we are experiencing a shift in America where fewer and fewer people need a W-2 job. The way we view employment is changing. It's time to begin extending our views of who is credible as a borrower. According to this CBS News article, the term redlining is a nod to how lenders identified and referenced neighborhoods with a greater share of people deemed more likely to default on mortgage. Using red ink, lenders outlined on paper maps the parts of a city that were considered at high risk of default, as well as more desirable neighborhoods for approving a loan. Riskier neighborhoods were predominantly Black and Latino. According to this Chicago Tribune article in the 1930s, surveyors with the Federal Homeowners Loan Corporation drew lines on maps and colored some neighborhoods red, deeming them hazardous for bank lending because of the presence of African Americans or European immigrants, especially Jews. At the time, the justification was that certain areas of a city were more at risk for mortgage defaults due to income restrictions, fewer opportunities, and crime. If we take a step back, that makes complete sense. If I'm a lender, it's critical that I know the risk with who I'm lending to, what their income is, what the valuation of the property is, and what the likelihood of mortgage default is. No one is arguing the logic. The problem is that segregation pushed certain groups of people into certain areas of a city, limited their opportunities, and then punished them when it came time to offer them a chance to become homeowners. Doesn't everyone deserve a fair chance in America? Here's the FHA's original underwriting manual from 1938. The risk rating system is designed to guide the judgment of underwriting staffs to attain a degree of accuracy and to secure a degree of controlled uniformity. The system requires the exercise of good judgment at every step in the procedure. It is not a formula which can be applied without discrimination. Cannot be applied without discrimination. I'm certainly taking these words way out of context, but that's exactly what the system did. Discriminated. You push a group of people into a section of the city devoid of good schools, opportunities, resources, parks, libraries, and anything that would bring up the value of property. And then you remove the ability to borrow for these consumers, and you create a negative, self-fulfilling prophecy. If residents of a certain neighborhood are denied loans, then the neighborhood will never appreciate in value. Cascading the problem is the disinterest in house flippers to enter the market because they have no one to sell their properties to. Dilapidated buildings and slumlords tend to be the result. America's entire economy is built on the ability to borrow. The real estate sector is the epitome of this tagline. If you remove the ability to borrow, then people won't be able to attain a mortgage. Home values stay stagnant, and the poor section of town will always stay poor. To combat the issue of redlining, the Fair Housing Act was introduced in 1968. Signed into law by Lyndon B. Johnson, the Fair Housing Act prohibited discrimination concerning the sale, rental, and financing of housing based on race, religion, national origin, or sex. Certainly, redlining ceased to exist in 1968 then, right? Wrong. The U.S. Department of Justice announced that it had reached an agreement with First Merchants Bank, an Indiana state chartered bank, to settle the redlining lawsuit that the DOJ filed against the bank on June 13, 2019. December 16, 2019. Wells Fargo to pay $10 million to Philly to resolve lawsuit alleging lending discrimination against minorities. There are plenty of other examples as well. Even if redlining does not take place anywhere in America anymore, the damage has already been done. Given the rise of home values over the past 90 years, how do you expect the group of people who weren't given a fair chance from the start to ever catch up to those who were? If banks are still getting caught today with certain unethical practices, then what do you think was really happening before the prevalence of information and compliance? This video doesn't even touch on predatory lending, which adds to the divide of wealth in this country between certain groups of people. A few weeks back, I began applying for a mortgage for the house I'm under contract to purchase. On paper, I have everything a lender would want to see. 775 credit score, 0 debt to income, a high income. I paid off $650,000 of debt last year alone. I have made every payment on time in my life, and my character is unquestioned. But because I don't have a W-2 and the algorithm rejects anyone without a W-2 right now, I have been struggling to find a loan. I'll find a loan because someone will give me a chance, but it made me realize how unfair lending can be to certain groups of people. In my case, that is borrowers without a W-2 right now in 2020. But I remember hearing about redlining when studying for my real estate license exam and realized how awful it must have been for those people throughout America's history who were unable to attain a mortgage loan. This is a very nuanced topic that has decades of history. This was just touching the surface of mortgage lending and redlining and its effects on certain groups of people. If you're interested in exploring this topic further, I will leave links in the description below. Thank you so much for watching.